Thank you, everyone, for being here for day 2 of Bloomberg Invest. And we're going to be talking about one of the, I suppose, the topics du jour, which is the data center build out. But of course, when we think about real estate and private credit, it's not just about data centers. There's a lot of other stuff going on, believe it or not. So we're going to be talking about some of those opportunities as well with Luke of Stonepeak and Julie of Ares. So very exciting to be here. Luke, why don't we start with you? You actually started investing in data centers relatively early, even before the existence of ChatGPT and all the new platforms. What did you see in that space that perhaps others missed in, say, 2018?
Sure. Firstly, delighted to be here. So excited for the panel. So look, we invested in data centers 10 years ago. It's when we first started investing. And our view at the time is how do we get access to the data proliferation trends, but invest in it from the infrastructure perspective. And where we invested heavily in is what I call interconnection data centers or carrier hotels. And they're really the old telephone exchanges. So the network infrastructure that really connects all the network players
Those
together.
Big windowless buildings that you see sometimes in New York, right?
Downtown Beverly Hills, downtown New York, prime real estate, but fantastic businesses. And our view is like society's getting more connected. We're changing the way we interact, and let's get ahead of that and invest in the infrastructure behind it.
So, Julie, one thing I kind of wonder is there's so much money going into data centers at the moment. Is there a crowding out effect when it comes to other real estate investment? Like, I guess that's a nice way of asking you, how jealous are you of Luke at the moment?
Very envious of you, Luke. But we do have a large data center business at Ares. We've been lending into the space for going on 12 years now. We've been buying data centers. We have our own development operating platform, too, that sits within our digital infrastructure business. And frankly, the growth and the attention around data centers is great for real estate and very much plays into what we've been talking about as new economy investors. What that means at Ares is that we are investing in the sectors that are benefiting from the fundamental changes in the way we live, in the way we consume, and the way we work. So the real estate sectors like logistics, multifamily, self-storage are very much benefiting from the growth in data centers because they're all so reliant on data consumption and distribution. So it's actually all playing very much together into the opportunity set for real assets as a whole.
Right, say more about how the growth in data centers would feed into something like logistics.
Sure. So if you think about the global logistics market and what are the drivers of demand of global logistics, you have shifting supply chains due to geopolitical factors. You have increase in e-commerce. E-commerce really only represents about 15% of retail sales right now. That's going to 35%. And if you think about just within e-commerce alone and the impact of data, and when you think about AI and the impact that that has, retailers everywhere are trying to increase conversions, so better ways to reach us as consumers. They want to have more efficient fulfillment centers, and then they want to figure out how to get those goods to all of us faster. AI is driving all of that. So there's a very clear impact of what data centers are providing, the infrastructure of how that then impacts logistics. Logistics buildings also, as an example, are typically in very well located proximity to large population centers. So with the increase in value of data centers, you can imagine the value impact that has on industrial assets as well.
Interesting. So, Luke, we're all trying to wrap our heads around how data centers actually work at the moment. But one thing I do know is that not all data centers are created equal. So talk to us a little bit more about where you're specializing and how you're trying to differentiate the business.
Yeah, great question. So given we've been in the space for a long time, we've seen how the whole data center market has evolved. You originally had the network connectivity assets. You've then had the cloud thematic. You've gone from the hyperscalers and now the AI thematic. Where we've really focused is continue to be around that connectivity thematic. As we went to large language model training, I guess our concern on a lot of that is what's the longevity? If you're investing in an asset, is it going to be there for 10, 15, 20 years? Or is your customer going to have completed its training and moved somewhere else? And so we've invested more recently in the inferencing workload, and that's where the assets are closer to the network hubs, closer to the consumer. You're taking a bet on actually the consumer uptake on AI programs, which we think is pretty good. We use them a lot across our portfolio today. And you've got long-term contracts in place with very creditworthy hyperscalers. So that feels like a good spot to be in. And I'd say the other aspect to it is your valuation. So we tend to develop and build a lot of assets, which gets you in at a pretty good entry price, as opposed to paying a high price for a platform.
How are you thinking about, I guess, the pure hardware degradation side of things? Because one of the things we hear, especially on the training side, is, the data centers are going to run those chips so hot and so hard and so fast that they have to be replaced much more than, if they weren't doing training. Is that one of the reasons why you're moving more into inference as well?
That's right, but we don't really take risk on the hardware, right? That's ultimately the customer of the data center who's paying us.
It's still your cash flow, though.
Exactly, but that's why we view just the inferencing workload as much more durable, as opposed to the training, the chips are worn down, and then what's the next capital refresh of that?
And the other thing I'm very curious about is, I guess, correlation risk among the customers of the data centers, because you can imagine a situation where, okay, they're all very creditworthy, but maybe they're all SaaS companies who are about to get disrupted by AI. There's been a lot of discourse in the market about that recently. How do you ensure that the actual customer base is diversified enough?
So, that's exactly right. You want to make sure you've got a diversified customer base. You want, the big hyperscalers are very high credit quality, like the upper investment grade. If you're getting a long-term contract backing your facilities, you need to have that. I think it's harder if you've got a mix of customers which have lower credit quality about them. It's a key consideration.
You could almost say, right, that you'd rather have a smaller, higher quality cohort than a larger, more diversified pool of clients that you're working with that don't have that credit quality, given the long-term nature of these leases, right?
I think spot on.
And this reminds me, but just in general, how competitive is the space at the moment? Because it feels like everyone is kind of fighting to get into these deals. When you're pitching yourself as a potential financer, how are you actually doing that, and how tough is that sales pitch?
Yeah, I would say, look, if you look at the hyperscalers today, they're under their leasing programs, right? So they're behind where they wanted to be. They're already leasing out 2028 space. Power connectivity is so key. Like that is the key to getting your offtake with your hyperscalers, having access to power. There's a variety of ways to do that. The grid is delayed in giving access, so you want to have a gas-fired solution as a temporary way to create power to your facilities. But that's the absolute key. If you've got the power, you're going to get the contract there.
And Julie, I'm just thinking back to the wider sort of new economy theme, but it feels like in the years immediately after the pandemic, it was a hot sector, kind of because people were looking for an inflation hedge and things like that. How much of that sales pitch has now flipped into an overall economic transformation story? Like, how much are people looking at this as, well, this is the future, we need to get on board, versus this is a cyclical play on potential inflationary economy?
It's a great point, Tracy, because what we actually have right now is the convergence of both, right? You have very strong structural demand drivers. They're just changes in the way we live our lives. And that relates to logistics. It's certainly being accelerated by all of data consumption. It relates to more flexibility that we want in our lifestyle. That's driving other types of real asset classes like multifamily, self-storage. If you're staying in multifamily, you still have the same number of products that you have. So you have these demand drivers that have really kicked up over the past few years. But you're now at a point where, following the rate hike that we went through, asset prices have effectively declined on average 20% plus. You have construction deliveries that have come down 50, 60, 70% in some sectors because of the cost of financing. And then you have more constructive capital markets. So you have also not just structural drivers around real estate fundamentals or real asset fundamentals, but you also have a cyclical opportunity here that's very strong. And that convergence is what we think sets up real assets for such a moment in time right now. But I would say it's not just a moment. When you think about a real asset or real estate cycle, it's many years long. And so we're just at the early innings of this. We're just past the inflection point of where the market has picked up. So we think it's a pretty exciting entry point that will create an opportunity for long term.
Actually, you just reminded me, you mentioned multifamily, so I have to ask about the state of multifamily because, of course, in some markets, especially the Sun Belt areas, the ones that went up quite a lot, we are seeing that drop right now. What's your take on just where we are in the cycle at the moment of multifamily?
Well, where we are right now is that we've been through a period of time since after the global financial crisis where housing stock has been undersupplied, right? We have an accessibility issue, we have an affordability issue that has persisted over many years now. So actually supply has come down considerably while demand for multifamily product has only increased. Home ownership, home affordability is high, flexible lifestyles are much more the preference right now amongst a larger renter cohort. And so you have really strong demand. What we faced over the past few years, particularly following the pandemic, was more supply that came into the market. It came into Sunbelt markets. At that time, Ares was actually monetizing a lot of our multifamily portfolios. That was a great decision that we made back then. But what we've now seen following the rate hike is there has been, in multi, at least a 50 to 60% decline in housing. It hasn't happened everywhere. Absorption has now really picked up. And so absorption is effectively now at levels that are above pre-pandemic. And that's the key. We need to see supply come down, moderate, and that's happening. It'll take some time in some of those Sunbelt markets, but that's where we always reinforce that real estate is such a local business. You got to understand the micro market and what's the dynamics within those locations.
And Luke, we should talk about energy and data centers. We were going to talk about this even before the events of the past few days, but if anything, it's more pressing. The thing you always hear, it's kind of become a cliche at this moment, is this idea that, well, the real constraint on the AI build out is on the energy side. How real is that statement? And then what can you do in your specific business to try to account for the energy needs of the AI build out in the data centers?
I'd say it's incredibly real. I think the new power projects in the queue are greater than the installed base of power capacity in North America at the moment. So that'll give you a extent of how much is trying to be built. I'd say at the moment, like the constraints are a couple of things. The grid, just the age of the grid. The grid hasn't had any growth in power. You're now forecasting a big increase in power through the transmission line. So there's more infrastructure needs to be built around that. That takes some time. Just to go and get a new grid connection in almost 4 or 5 years in some jurisdictions for getting into the queue. And so the alternative is building your behind-the-fence power system, typically gas-fired. And so, again, the constraint there is on supply chain, turbines. It takes a while to order the turbines, 3-4 years out from a supply chain perspective.
Well, people are still talking about a transformer shortage as well, right?
Exactly, all the key products going to the development of the power infrastructure. But we see a big thematic in that build-out of behind-the-fence gas-fired power. The key there is having like dual fuel capabilities as well, so you've got the reliability for the hyperscalers. I'd say the other area too, which I think is pretty interesting, is the renewables, because renewables have been a bit beaten down. But if you think about what's the quickest way to get new power supply into the grid, it's building solar and wind. So we see that thematic continue, driven by what's happening from a AI demand perspective. And if you look at the next couple of years, there'll be more renewables built than the last 2 years, despite some of the volatility and the changes in the Inflation Reduction Act affecting that. So I think that's going to be a big thematic, all the power build out to support this. It's real, the crunch is there. That's the constraint to getting the hyperscalers there. They need to see the power, and there's a lot of capital going in to build that at the moment.
And to your question earlier about the competitiveness of the space, you can see right there groups like Stonepeak, groups like Ares, who have that ability to see across the continuum of what's needed to actually serve your clients, not just from a capacity and a construction and infrastructure perspective, but from energy, the capabilities that you all have, that we all have. That's what provides an edge in this
sort of holistic view
in this competitive space, because there's so many dynamics at play.
Yeah. I mean, the other big thing that's happening on the data center side is we're starting to see some political pushback. It's very hard to pitch a story to voters of, well, your energy costs are potentially going to go up and you're going to lose your job. Congratulations. How are you thinking about that particular on the policy side?
Yeah, I think it's a real risk. It's well pointed out. What we're seeing is the data centers actually starting to bear more of that risk. And you've seen it play out recently in the last few months where some of the hyperscalers are, look, we're going to compensate that through what rate we pay for an industrial load. So therefore, making sure that power prices don't pick up on the actual consumers. So I think that's how that's going to be addressed, and we're seeing that real time.
And when you're thinking of data center deals, can you sort of rank the risk factors that you're considering? Is it like the quality and diversification of the customer base? Is it the energy needs are actually satisfied? Is it like, oh, wait, I don't want to actually invest in an area where there's a politician who's currently making noises about data centers? How are you ranking and thinking through those things?
Yeah, so I'd split the market into a couple of areas. I think the interconnection hubs I touched on earlier, like they're good investments. They're good in all the areas. They'll continue to be pretty strong through whatever the thematic is, particularly around the AI hyperscale thematic. I'd say when you rank it, like power connectivity is binary. Like if you don't have the power, you shouldn't be going into the investment, right? And you need a solution, and you need that redundancy as well of the power supply, because that's key to your off taker. So that to me is a binary position. If you're looking at a new facility you're going to build, I'd say then it's credit quality of the off taker. What's the workload? Like large language model training versus inferencing. For us, there's a big difference in what's the longevity about that. We don't want to take a bet on who's winning the training race. And if I've got a 7-year contract, do I know they renew? If I'm in Nevada or West Texas, I could end up with an asset that probably has some obsolescence to it. So getting behind the right long-term thematic, which we think is the inferencing one, because we, as I said, we use it across our portfolio today. We see real-time benefits from AI that are having financial improvements in what we have. And so we think that's a great thematic. And then it's the duration of that cash flow you're getting. You're locked in a diversified, high credit quality tenant is key. And then valuation is absolutely key. Like, I'm not going to do that if I'm going to pay a high price for it. We'd rather build, and then you're at a pretty good valuation. So that's how I'd think about it.
Since you mentioned valuations and financing, that also reminded me that, again, this is a very eventful week, and things seem to be changing very rapidly in markets. But if we do get a return of inflation and a rate cut from the Fed is off the table, what does that actually mean for the health of real assets?
I think first you want to contextualize where we are today, right? Which is we went through a period of very steep, very high rates. And for real assets, the asset class repriced. So if anything, we're in a pretty good position as far as entry point from valuations, and we really do believe that has settled out. The Fed has gone through a normalization cycle, which we're largely through. Would lower rates be beneficial to an extent? Yes, but I think what you actually see more than anything is that in this next chapter, whether rates move up, whether they stay where they are, whether they move down a little bit, the next chapter is going to be about driving cash flow growth, right? You're not going to be able to ride the momentum of the market, and that's where investing with managers who have capabilities to drive operations, to improve the actual quality of the asset, and are really sitting at the center of all these different dynamics, that's where the edge is going to be. So you have, in many regards, leases that have escalations in them going up by year that help address inflation. It's one of the beauties of being invested in real assets, and we think that where we are right now provides a constructive environment and actually keeps a lot of discipline in the market.
Luke?
Yeah, I totally agree with that. Look, I think it was harder to invest 4 or 5 years ago when rates were low. Like if you look at the real assets sort of spectrum of all the different sectors, you've got high inflation-linked assets, pricing power. Real assets generally perform pretty well when you've got high bouts of inflation. You've seen the higher interest rates play through, so the valuations are much more interesting today than what they've been for some time. So we've found it a pretty good investing environment from an entry price perspective. And then overlay the current market volatility. We tend to lean into volatility. Like you're buying assets which are long duration assets you're going to hold through the cycle. And so the best time to buy them is when there's a lot of volatility out there, because you're going to get a good entry price into those assets. And so we've found it a very good investing environment. Now, you've got to pick your spots, right? There are assets which are overvalued, and you've seen the hype around hyperscale, but there's good ways to play it by building your own platforms, and we do a lot of that development and construction ourselves. So I think it's a very good investing environment at the moment.
You mentioned some things being overvalued. Obviously, we cannot have this conversation without talking about the actual supply outlook of the AI build-out and whether or not we are actually in a bubble. People feel strongly on either side. So you see some people argue that we're all going to become vibe coders and, the inference needs are going to be just ginormous in the coming years. And then you hear other people talk about, well, we're in .com bubble redux. I would love to hear from both of you, given that you've lived through many cycles in the real estate space, how you're thinking about that particular question.
I think from a starting point, and Luke talked about this early on, the demands to support not just AI, but just general computational initiatives that are underway, the demand for infrastructure is enormous. We don't believe that there is a bubble around the infrastructure needs, and that's why you need groups who are knowledgeable, who have the capabilities, who understand the impacts of the broader market and the energy needs to support that infrastructure. And so while there's a lot of discussion when you cast a very wide net around the industry, there are questions about individual companies, but the actual physical infrastructure needs, given the demands that we see that are going to be 300 to 500 times what we have today, if you look forward over a 5-year time period, are very significant.
Yeah, I agree. And it's totally different. Like .com was very speculative. It's not like people are building infrastructure with a hope that someone's going to use it. Like there is long-term commitments behind that infrastructure. But I just think of the anecdotes that we see across our own portfolio. We own over 50 or 60 different companies. We're seeing the benefit of AI, like we're using it in terms of reducing costs from a call center and customer interaction. We've got another company where we do hundreds of thousands of customer interactions through different channels. The accuracy of that's about 80%, that interaction. We've been able to reduce the cost of that interaction by 2/3 and increase the accuracy to 100%. And so we're big believers in that thematic, and we're going through a global digitalization of everything we do, and the infrastructure there to support it feels really good at the moment.
Is there anything that would make you nervous in the space? Like, what are the actual signs that you're looking out for where you're thinking, okay, wait a second, maybe things are getting a little too exuberant?
I think, certainly, you've seen the valuations come in a bit with some of the recent sell-off, but I think the valuations we're getting very toppy, like large platforms were really prime valuations, which were hard to justify. So certainly, I think from a valuation perspective, to me, that's a little bit different to the demand perspective. They sort of two separate discussions. So I think that we had seen valuations come up and then have come down. I do think on the demand, I think the risk is more around the training. And so do you have some of the hyperscalers saying, okay, well, I don't quite need these facilities because I'm training onto the next module, and do they sort of consolidate that? I feel like that's more where the risk is on the end market, as opposed to the inferencing, the workload, and the end consumer demand feels very good.
Julie?
Yeah. I would say with regard to the topic around AI and the build out of infrastructure around it, I think the concerns that Luke noted are the primary ones out there. Clearly, you want to make sure in any market, particularly when there's this much exuberance around it, that you have the right players, right? That you have the right groups that are out there that are providing the financing, that understand the risks, that there is appropriate liquidity when that's deemed necessary. And those are the types of items that we really focus on from a risk perspective. And then more broadly, there is a lot of volatility in the market, as we've talked about. That presents risks. It also presents opportunities. But you want to balance all of those views with how do those then make it through to the day-to-day consumer. And that's what we will all be focused on going forward. But right now, there hasn't been any clear evidence that has changed.
And Julie, you mentioned the infrastructure build out in general, and you hear these numbers, estimates thrown around of like what's actually needed in the US, and it's often in the billions, if not trillions of dollars. Is anyone talking about public-private partnerships at the moment, like the idea that maybe the government could step in and provide some of that capital? I feel like we go through waves where, it becomes a very big topic and then everyone forgets about it and it goes away and then it returns.
It's an interesting question because it certainly brings in, when you look at real assets more broadly, that the public sector has actually played an important role. And we've seen that in some of the asset classes that we participate in. We've invested in multifamily, for example, within the frameworks of local government policies. That's worked really well for us and helped serve a need for a particular city, for a particular region. I think more broadly, you always just need to take into account what are the political considerations, and in this environment, how is the government going to step in to take on that role? There's a lot to consider there.
Luke?
Yeah, I think we haven't seen a huge extent of it, but I think areas where the government can help with things like permitting and streamlining that, especially as the US wants to be the leader in AI, making sure we do get the infrastructure built and pulling back the constraints that actually build it, which tends to be a lot on the permitting side. So I think that's, if you're going to do something in coordination with the government, I think that's where they can be very impactful.
Does it feel like they're serious about making the permitting process a little bit easier?
It tends to get state to state.
Yeah.
That's often the challenge in the US, that like you have that overarching federal mandate, but a lot of the permitting's down to local permitting.
How bad is it actually? Because we hear these horror stories of, projects that have been stuck in permitting for like 3 to 5 years.
We haven't found it too bad in data centers. It's more the getting the supply chain and the power is more of the constraint. But in terms of like local permitting to build a data center, it's pretty streamlined. Again, it's state by state.
All right, well, we only have a couple minutes left, so I want to ask both of you a sort of big picture, I guess, career-oriented question, but both of you have been through multiple cycles in the real asset industry, and you've seen large influxes of capital in the past, and you've gone through cycles where your own business has grown enormously and scaled up very, very fast. What's the one thing you've learned from previous, I guess, booms that you think is valuable in the current environment?
Well, I think with all these things, it's entry price. Don't get seduced by the thematic, and I think with it, it's like you'll play through the cycles. And I'd say the other thing is we lean into volatility. Like when there's volatility out there, play the long game. Like take advantage of it. But at the end of the day, getting into assets, long duration assets, it's all about that entry price and then what you can do to drive value over it. But I would say that's the thing, like, especially when I think about hyperscalers, it's easy to go, wow, it's a great growth thematic and end up overpaying for it. Like you've got to be very, very disciplined in these markets.
I think it's a great point because especially when values have repriced, you can end up in second-tier markets. You could be coming at a lower entry price, and that could seem attractive, but it could just be cheap for a reason, and you aren't able to actually drive that cash flow. And I think what I've learned through investing across many cycles, many different environments now, it's all about driving to value creation. You can have a great entry point, but you need the capabilities, the skills, the people on the ground. You've heard us say throughout this discussion, local, right? It's about the local government, it's about the local population, it's meeting those needs, and understanding that within the real asset space is incredibly important, and that's why we've been constantly investing in our business to expand that capability set.
All right, Julie and Luke, thank you so much for a wonderful conversation, and thank you very much to the audience for being a great crowd. Thank you to our sponsors, Invesco QQQ,